So this video is about the price of gold, and I'm saying that right off so the algo can read it and know what I'm going to be talking about. So now, here's the intro. So hello there. I've just got back from Tokyo. I left on Monday. I got to Tokyo on Tuesday night, did some business Wednesday, Thursday, got on the plane Friday morning, stitched myself up with flights, so I spent 18 hours in Peking Airport in the lounge, and then got back Saturday night. So I'm a little bit tired. But anyway, you don't care about my global travels. What you care about is the price of gold. And well, me too, because I got a lot of it. So let's have a look at where gold is right now and have a think about what that means. Now, before we do, I've just got to thank all my members for joining the membership level. And a lot of what you're about to hear is based on a technical way of looking at the markets, which I covered in my first membership video, which you can see in my video list. Let's get into gold. So first of all, here is a chart of the trend. Now that's the trend, not what's just happened recently. There it is. See? Now we've run ahead of that trend quite a long way, and it doesn't mean we're going to come back to it, but that's the original kickoff for this whole gold move. So you can see that that trend is relatively strong, and if it was a long-term trend, that would be great news for us over the next 2 or 3 years. But we're not on that trend. We've had a spike up, and that's caused by all the conniptions we've got going in the world of geopolitics, and there's enough of them. But underlying it, that long-term trend is countries buying up gold for their reserves, and those reserves are being built up because global tension is increasing. Trump was in Asia last week when I was there. Unfortunately, he missed me. There was a meeting between him and President Xi of China. And as I read it, basically, in a very gentle way, China slapped America down. It said, we don't really care that much. And because of that, America has had to step back. So anyway, there was a deal, but really, it's a nothing burger. Yet the change to all the tariffs is quite significant. In a sense, unlike Europe, unlike everyone else who just capitulated, China has said, no, and basically implies that China doesn't need America, which actually, when you look at it, it doesn't. 14% of China's exports go to the US when I last looked. And that's really not a great deal when you think about it. So if you were to lose half of that number, yeah, it's a bit of a setback. But it's not necessarily a massive setback, particularly when the rest of the world is suffering from American tariffs and you can just go to them instead. Outside of that, global tension doesn't seem like it's going to be going down anytime soon. Obviously, the situation in Ukraine and Russia is still relatively acute. The situation with China and America and implicitly Taiwan has absolutely not gone away. So therefore, we can expect this stress to continue, and we can expect countries to continue to build up their gold reserves, so we can expect this long-term trend to continue. And that's really the bottom line. This trend is the bottom line, and we can expect that gold will continue to go up bit by bit by bit. So even if this spike, which we see at the end, comes back down to that trend line, we'd expect gold to then carry on. That is one way of looking at it. Let's move on to another chart. I spoke about this in a members video. This is an idea that there are repricing moves. And actually, I need to do another chart, so I'll go do that now. So we have this chart, and I went into detail in my membership video how this works. But you see, there's areas where there is equilibrium, and then you have a breakout. And that breakout tends to then move to a new equilibrium, which is the same distance as the previous move to a new equilibrium. And the reason for that is mathematical, and I explain all that, and I explain that in the membership video, how you can use that and how it all works. But here you see this at work in the gold price. So you can see these equilibrium points, you can see the breakouts from them, and then you can see the distance of travel thereafter. And because you're basically presented with a 50-50 at these equilibriums, and when they break out, it moves. It just doesn't move a short distance, it moves generally quite a long way. And that gives the trader a real opportunity to jump on board a big move and capture quite a lot of it. The trick is knowing when the breakout is there and when you should jump on, and that's really down to what the trader wants to do. And obviously there's a lot of people that are trading gold rather than people like myself who are just investing in it and holding it to the point where they think it's gone up enough. This means the following might happen. And here's another chart. At the end there, we're in a new equilibrium. And it's very early days for that equilibrium, and you could get a breakdown. And if we got a breakdown, you would get this. And this, as you can see, would be a sharp move down. But I think what we will see is we'll see a sideways trade now. And it will just go sideways, and to further notice, within the range of that equilibrium. Now, that range of equilibrium is to be announced, to be discussed, to be confirmed, because it's such an early stage. It's at a stage where it could just break down, or it could go across and form a long-term or medium-term or even a shortish-term equilibrium level, as it has done in the past. That's what I'm expecting, but the market doesn't listen to me. I listen to the market. So I've got that box that I think is a likely equilibrium range, and that's based on the past because the market has seen fit to set the volatility as that wide for a sideways trading range. So I'll use that as a guide. So if it breaks up through, you get this chart to 5,000. And if it doesn't break through, it breaks down, you get this chart, which will be the next level where you'd expect it to start to try to build an equilibrium and trade sideways. And then you put another box around it to see whether it's going to go down. Then you would expect, if we were in that sort of bear move, it to hit that long-term trend, unless all of a sudden everybody was being sensible and giving each other hugs and saying, let's do world trade again and let's all be friends. I don't think that's going to happen. What I think is going to happen is we're going to take a rest now, and we're going to form a sideways equilibrium kind of around this price. And then I'm expecting somebody to get annoyed with somebody and for the price to go up again, or for the long-term trend to catch up with this level and it to move on upwards from there. Going back as a summary, we've got this long-term trend, and you can see the price putting right back to it if the reason for this spike went away, which I don't believe it will go away. What I believe will happen is that it will pull back, well, it has pulled back to around here, and it will now sideways trade as an equilibrium, and at some point it will break up or down, and I think up, because that pressure will still be there, that tenseness will still be there, that increasing cycle of more tension will go on, and it will then move up to 5,000. Now, the idea below this, in my book, is that the driving factor is Taiwan, and that China has made it clear that it wants Taiwan back, and 2027 is their T-Day for that action. And the West, America and Europe, are all working towards being ready themselves for some kind of global conflict or the potential for one in 2027. And if you speak to people in the know, or maybe not quite in the know, but near the know, then they talk about 2027, because that is the date that China has pretty clearly stated they want Taiwan back. And they're going to take it back is the implication, because the PLA, the People's Liberation Army, has been told by Xi to be ready by 2027. And the question is, ready for what? And obviously the answer is ready to take back Taiwan if it can't sort it out before then. That is the drumbeat of tension. Now, what I think would happen if China was sensible, it would just let that run, because really it's now got the whip hand. America would like to think it has. It's got a massive, massive army, but it simply can't afford to cut China off. And we've seen that in these negotiations. China makes everything for everybody, is the workshop of the world. And if you cut yourself off, it's like cutting yourself off from Walmart. You're going to go pretty hungry. So if it was sensible, it would just sit there, but it won't stop it getting ready for conflict, because America's made it clear that it wants to stay top dog, and that has implications too. Now, if they were to kick off in 2027 over Taiwan, can China pull it off is a question. But what would America do? Would America go into Armageddon, or would it just go huff and puff about it and do very little? Well, I think that is an outcome. But if you think about it, global tension is not going to go down in that event. It's going to continue to go up, because there'll now be not only a standoff, but a reason for there to be a standoff. And that will only make yet more tension, and therefore gold will go up yet more. We're only going to be on this treadmill of increasing global geopolitical tension that will continue to drive the gold price, which there seems to be no top to in that model. Thank you very much for watching. It'd be nice if you subscribe. It would be nice if you like. It'd be really great if you can comment. And I'll be back soon. Bye now.